This chart gives you something to think about. It shows the net revenue of CROX worldwide all the way from 2014 to 2022. And look at that, it's been stable all the way from 2014 to about 2019, and since then it really started to pick up. This, we believe, will continue in this way, and we believe that CROX is right now an incredibly undervalued company. Think it might be a great opportunity as it has a high brand loyalty business with extremely good management, but it has one worrying financial metric which we will discuss in the following slides. So of course, we're talking about CROX, clothing brands. It has two, that's why we put brands. It has a newly acquired company, which we will talk about right now. We strive to be the world leader in innovative casual footwear, combining comfort and style with the value that consumers want. That is something found in their annual report, and it's good that that is their vision. In 2022, last year, they acquired a company called Hey Dude, which is, of course, a company that also provides shoe wear, but very comfortable one, and it's more discreet than Crocs' usual style, let's just say it that way. However, this acquisition actually worsened their financial position as they increased their liabilities by a lot. They lowered their interest coverage ratios and have left them in a pretty vulnerable position. However, since then, they are slowly improving their conditions. They have been paying back around 20% of their long-term debt in only 1 year, which is astonishing, to be honest. And that is why we believe they deserve a growth. Well, this and the fact that their PE ratio is it's 10 or even lower right now. So their current growing strategy has 5 main points to it. The first one is to grow their digital sales, which are currently 38% of revenues. Second one is to grow their sandals market share, which they believe it's one of the most important segments to their business. And of course, leveraging and unleashing the Hey Dude brand. They purchased this and they believe that it is the main source of growth that they will have in the following years, and they really want to leverage this one. They even they purchased and leased a new distribution center specifically for Hey Dude, as they believe that this has many untapped opportunities and it is still only known in the US. Of course, adding to this, they have more international growth opportunities for both their brands, which right now account for 29% of revenues, but in Asia and the Pacific, CROX sales have been growing insanely fast for the past few years. And apart from this, they want new product and innovation. So another thing that they said is that we do not believe that we compete directly within a single companies with respect to the entire spectrum of our products. And I agree with them, because you try to compare them to their industry peers and you have companies like Nike, Puma, Skechers, but they're not providing the same offerings. So let's move on to the financial analysis of 2022. Their return on capital employed was incredible, and 19% is really, really, really high, especially comparing it to their peers, with very good profit margin of 52% and an operating margin of 24%. Their cash conversion as well was 71%, which was pretty solid. We want this to be closer to 100%, but they are getting there. And the only worrying metric is their interest cover and their debt. But this, of course, comes from a situation from an acquisition, and we have seen how they are covering it very well, and they are, of course, making extreme debt repayments, which are really good because they're not using their whole free cash flows to do the debt repayments, but yet they are still managing to keep it under control and lower the payment quarter after quarter. In terms of the financial analysis of their main metrics, we can see that their return on equity has always been really, really high. It has recently decreased, but it is still over 60%. And then their other returns, which are return on assets, return on sales, and return on invested capital, they all seem very low in this chart. However, the lowest one, which is return on sales, is above 15%, and their return on sales and return on invested capitals are more around 26-27%, which is incredible. And look at that, their return on invested capital is up 33% year over year. So these are very positive news for the company, and it is great to see that they can keep it very, very stable throughout the quarters. In terms of fundamental analysis, we give them a 7 out of 8. Of course, the one is low liability risk, because this is the thing that scares me the most. However, since I have been seeing them repay it at such a quick pace, I am really, I think this company can handle this and has it well under control. So apart from this, they have a pretty solid balance sheet. They have very good cash flow consistency, except for the one quarter where they actually did the acquisition. I believe they have good pricing power, and they have a moat and a competitive advantage because it is the only company that it is It is the leader in comfortable shoe wear, and it is the only company that has a product so differentiated and with such brand recognition that you basically know them from anywhere. And they have a very, very, very loyal fan base, especially the one that's developing in Asia, which I believe is the one that will funnel this company to new heights in the following years. Apart from this, they have very good organic free cash flow growth and organic revenue growth, and they're conducting share buybacks. The thing I'm betting on here is that when they actually manage to pay all their debt, which is pretty high still, but they're doing it at a fast pace, whenever they manage to decrease their liability to a normal or more safe ratio, they will start to do buybacks in a more aggressive way. In terms of valuation, I think this company historically trades at a pretty cheap ratio, and I don't understand why. Right now, they're sitting at around from 10 to 9 PE ratio, and as you can see historically, it is at a pretty standard price for the past 1 year and a half, 2 years. It did go up in price in 2020, but right now it's pretty stable. It trades at a big discount in terms of PE ratio in comparison to their peers, and I still have not discovered why, but I don't find there a reason for this. I think it's just because it is a misunderstood stock, and I have not found any underlying risks that could indicate this or that could make this PE ratio reasonable. In terms of free cash flow yield, for using 2022 data, they have a free cash flow yield of 8% with the current price right now, which is a lot higher than the long-term inflation rate. And according to the Terry Smith fundamentals that we use for our investing thesis, is that whenever a stock has a free cash flow yield higher than the long-term inflation rate and it has growing free cash flows, this is at an attractive valuation. In terms of risks and possible challenges, I try to do this conservatively, but I didn't find much to go against them. In terms of competitors, I do agree that they are competing with fierce companies such as Nike, Adidas, and other shoewear giants. However, I don't think they're fighting for the same consumer or for the same actual need. As they said in the first slide, they don't have any 100% defined competitors. In terms of regulation, there are no regulations for these kind of shoes. I don't think it's anything crazy will happen in the following 5 years, and I think that in that aspect they're safe. In terms of performance, I think I put a 50% just in case, just trying to be conservative. However, they did reduce their guidance for next year quite a bit, and I believe that that is one of the reasons why I'm not putting performance in a higher risk. I'm just being conservative with it. And in terms of market, if there is an economic downturn, maybe the sales will reduce, but I don't see that. First of all, I don't see this happening anytime soon. And second of all, it's CROX. It's not like it's a big purchase, so I don't think this will be heavily affected by anything like that. In terms of, just moving on to the investment conclusion, before we move in onto this, of course, you have to know I'm not a financial advisor, and this video is not financial advice at all. So please don't listen to me and don't take it wholeheartedly. I do hold a position in this company. I just purchased it. But this should not be an indicator of you to purchase it. Please conduct your due diligence if you decide to buy it. But I believe that they do have a moat and a competitive advantage since nobody else has a similar product to theirs. They do provide consistent cash flows, very resilient, and they have extremely high return on capital employed to be in this industry. So I do believe that they are not a risky company that should be changed. I believe that it's a great company that will generate high returns in the future, especially when they get their payments done and they're able to buy back their share. So thank you for watching. As always, this has been the Cashflow Compounder. Please join the free Patreon for extra content, and there is a link in bio for a free stock for Trade Republic and Trading 212.